What if the official inflation rate you see on the news every week is a completely legal lie? While the price of eggs, milk, and gas is skyrocketing, the value of luxury cars and million-dollar homes is secretly plummeting. Welcome to the harsh reality of beflation, a freak economic state where inflation and deflation happen at the exact same time, squeezing the working class while opening a massive back door for the smartest money on earth. Welcome to BlockDocs, where we strip away the noise to expose the raw truth of crypto and global finance. Hit subscribe to track the money with us, and let's get straight to the story. So, why digital asset markets ended 2025 relatively flat, but are quietly building massive pressure for 2026? We have to redefine the economy. The global economy isn't in a pure recession, and it's not exactly stagflation. Instead, we are living through an extreme version of the Cantillon effect. Central banks are pumping liquidity into the system to service a staggering $38.5 trillion in U.S. national debt, which now sits at over 120% of GDP. The U.S. government is now paying over $1 trillion a year just in interest. That money flows directly into scarce assets, while tight credit conditions crush the demand for heavily leveraged items. The main characters in this new reality aren't retail day traders. They are institutional giants like Fidelity Digital Assets. Chris Cipher, director of research at Fidelity, calls this blockchain's shipping container moment. Decades ago, a simple rectangular steel box cut global shipping loading costs by 95%, bringing the price from over $5 a ton down to just pennies. It took years for the world to retool its infrastructure, but once it did, global trade changed forever. Bitcoin is sitting exactly at that historical inflection point. Between 2015 and 2025, rigorous econometric testing proved a deeply stable, long-run equilibrium between the USM2 money supply and Bitcoin. Empirical data shows the long-run elasticity coefficient is 2.65. That means for every 1% increase in the M2 money supply, Bitcoin's price tends to increase by 2.65%. Bitcoin operates as a highly elastic asset, acting as the ultimate sponge for excess macro liquidity. By the end of 2025, the institutional sprint was undeniable. The number of public companies holding at least 1,000 Bitcoin on their balance sheets more than doubled, jumping from 22 to 49. Nearly 5% of the entire 21 million Bitcoin supply is now locked up by these 49 entities. The distribution is aggressively skewed. The strategic tier holds almost 80% of those coins. If you exclude the single largest player, the remaining 11 strategic companies hold an average of 12,346 BTC each. At the exact same time, CME Bitcoin futures saw open interest explode to $11.3 billion. This wasn't retail gambling on offshore apps. This was regulated professional capital building a permanent footprint. But under the surface, a deep ideological and technical crack formed within the network. Bitcoin Core developers released version 30, altering a data limit policy to allow non-financial data embedding. This triggered a severe ideological war. The opposing camp, Bitcoin Knots, viewed this as network bloating spam. By December 2025, the split was highly visible on-chain. Core V30 nodes represented over 15% of the network, but Knots IE 29.2 was right behind at 11%, proposing a soft fork to censor these transactions at the consensus level. A brutal leverage washout swept through the derivatives market, triggering mass automated margin calls. During that absolute panic, Bitcoin options open interest spiked over $60 billion, completely dwarfing perpetual futures. Cash and carry hedge funds were forced to violently close their positions. Simultaneously, a massive pivot happened in the mining sector. Cipher Mining signed a 15-year, $5.5 billion lease with AWS, and Iren Limited inked a $9.7 billion deal with Microsoft. The biggest Bitcoin miners were quietly converting their energy infrastructure into AI data centers, threatening to flatten the network's hash rate going into 2026. In that moment of absolute panic, as billions in derivative leverage evaporated overnight, something counterintuitive happened. Bitcoin didn't crash to zero. It slammed into a concrete floor right around $80,000. Why didn't the floor fall out? Because the buyer base had entirely mutated. While retail and leveraged speculators were violently ejected, the 49 public treasury companies simply stepped in and absorbed the supply. Even more aggressively, the very first central bank entered the chat. The Czech National Bank established a digital asset test portfolio, proving that sovereign accumulation was no longer a theoretical debate. And what about the United States? As the U.S. debt crossed $38.5 trillion, the government was quietly holding roughly 200,000 seized Bitcoin, around 1.5% of the total global supply. The October 2025 shakeout wasn't a cycle top. It was the final, violent transfer of power. The asset moved from the weak hands of over-leveraged day traders directly into the cold storage of sovereign wealth funds and institutional giants playing a decade-long game. The question isn't what happened during the crash. The question is what this permanent structural shift means for the money in your pocket right now. The story of biflation, the core versus knots fork, and the institutional absorption teaches us a very specific, actionable reality. As an investor, you have to stop looking at Bitcoin's short-term technical indicators and start tracking the M2 money supply elasticity. Econometric data proves that 12% of any deviation from the long-term M2 equilibrium is corrected every single month. If you are trading the daily noise instead of the macroeconomic liquidity trend, you are simply serving as exit liquidity for Fidelity and Wall Street. Second, the shift of hash rate toward AI hosting isn't a flaw. It is a structural upgrade. It provides miners with an alternative, highly profitable revenue stream, making the underlying network security far more resilient to raw price shocks. We are watching the birth of a dual financial system. Fiat currencies, choked by fiscal dominance and endless debt monetization, are slowly bleeding out. Meanwhile, Bitcoin is being fully financialized through CME futures, $124 billion in spot ETPs, and Iren adoption, all while keeping its hard-capped 21 million supply intact at the protocol level. It is the shipping container moment for global value transfer. What do you think is the biggest threat to Bitcoin in 2026? The US debt environment, or the internal developer war over network spam? Let me know in the comments, and see you in the next structural breakdown.